In this video, we'll discuss the do's and don'ts of crypto investing so you can make the most of your investments. If you're looking to invest in crypto, it's important to be aware of the do's and don'ts. Investing in crypto can be a lucrative venture if done correctly, but it can also come with risks if not done properly. Whether you are a beginner or an experienced investor, understanding the basics of crypto investing is essential to success. Do your research before you start investing in cryptocurrencies. It's essential to understand the crypto basics and the fundamentals of crypto investing. Investing in cryptocurrencies can be very lucrative, but it can also be very risky. Therefore, it's important to take the time to learn and understand what you're investing in. Here are some steps to get started. 1. Understanding cryptocurrencies. To start investing in cryptocurrencies, you need to have a good understanding of what they are and how they work. Cryptocurrencies are digital or virtual currencies that use cryptography for security. They operate on decentralized networks, which means they are not controlled by a central authority like banks. It's important to understand the technology behind cryptocurrencies and their potential applications to various industries. 2. Choosing a cryptocurrency to invest in. Once you understand the basics of cryptocurrencies, you need to choose a cryptocurrency to invest in. It's essential to do your research and select a cryptocurrency that has a good track record, a strong community, and a clear use case. Look at the project's white paper, website, and social media channels to learn more about the project. 3. Choosing a cryptocurrency exchange. After choosing a cryptocurrency to invest in, you need to choose a cryptocurrency exchange to buy and sell your digital assets. It's crucial to choose a reputable exchange that offers a range of cryptocurrencies, low fees, and excellent customer support. It's also important to consider security features such as two-factor authentication and cold storage options. 4. Storing your cryptocurrency. Storing your cryptocurrency securely is vital to prevent theft and loss of your assets. You can store your digital assets in a software wallet, a hardware wallet, or a paper wallet. Each type of wallet has its advantages and disadvantages, so it's essential to choose the one that suits your needs and preferences. Don't go all in. One of the biggest mistakes that newbies to crypto investing make is going all in with their money. This means putting all of your money into one particular crypto asset without diversifying your portfolio. While this strategy might work for some, it is generally not recommended, especially if you are new to the crypto investing basics. Instead of going all in, consider spreading your investment across multiple assets. Diversification is key when it comes to investing, and the same holds true for crypto. This not only spreads your risk across different assets, but also allows you to potentially profit from various cryptocurrencies. Another important point to keep in mind is to not invest more than you can afford to lose. The crypto market is extremely volatile, and prices can fluctuate wildly in a matter of minutes. So, it's crucial to have a long-term investment horizon and avoid getting swayed by short-term price movements. To sum up, when it comes to how to invest in crypto, don't go all in. Spread your investment across different assets and avoid investing more than you can afford to lose. By doing so, you'll be well on your way to building a diversified crypto portfolio that can withstand the ups and downs of the market. Do diversify. When it comes to investing, diversification is key. The same applies to investing in cryptocurrency. It's important not to put all your eggs in one basket. While there may be one particular crypto that is currently booming, it's essential to diversify your investments across several different currencies. This will help to spread out the risks and protect you against potential losses. Diversifying can also mean investing in different types of cryptocurrencies. You can choose to invest in both stable coins and volatile cryptocurrencies to balance out the risks. You could also invest in a variety of currencies, including Bitcoin, Ethereum, Litecoin, Ripple, and others. Each has its own unique properties and risks, and diversifying your investments can help protect you against losses in any one particular currency. In addition, you may want to diversify the way you invest in crypto. Instead of solely buying and holding, you could invest in mining, trading, or staking. Each method has its own unique risks and benefits, and diversifying across them can also help you to manage your overall crypto investments more effectively. In short, diversification is essential when investing in crypto. By diversifying your investments across different cryptocurrencies, methods, and types of currencies, you can minimize your risks and protect yourself against losses. Always remember to do your research and choose investments that align with your financial goals and risk tolerance. Don't be swayed by FOMO. FOMO, or the fear of missing out, is a powerful emotion that can influence decision-making. When it comes to crypto investing, FOMO can lead to impulsive actions that can result in losses. It's essential to avoid getting carried away by the hype around a particular cryptocurrency or investment opportunity. One of the best ways to resist FOMO is to stay informed about the market trends and do thorough research before investing. Don't make any rash decisions based on a sudden spike in value or news that a celebrity has invested in a particular cryptocurrency. It's also crucial to set clear investment goals and stick to them. Don't let the fear of missing out drive you to invest more than you can afford to lose. It's always better to take a cautious and calculated approach to investing rather than to act out of FOMO. Finally, remember that the cryptocurrency market is incredibly volatile. The value of a cryptocurrency can rise or fall rapidly, often without warning. Therefore, it's vital to avoid being swayed by FOMO and making impulsive decisions that can result in significant losses. Stay informed, set clear goals, and stick to your investment plan. By doing so, you'll be better equipped to navigate the unpredictable world of crypto investing. Do have an exit strategy. One of the most important things to keep in mind when investing in crypto is to always have an exit strategy in place. This means knowing when to sell your assets, whether it's to take profits or cut your losses. Without an exit strategy, you run the risk of making emotional decisions based on market fluctuations or FOMO, fear of missing out. This can lead to holding onto assets longer than you should or selling too soon, which can negatively impact your investment returns. To create an effective exit strategy, it's important to set clear goals and have a plan in place for when those goals are met. This could involve selling a certain percentage of your holdings at a specific price point or implementing a stop-loss order to automatically sell if the price drops to a certain level. It's also important to regularly reassess your exit strategy and adjust it as needed. As the crypto market is highly volatile, factors such as news events or sudden price changes can impact your original plan. By having an exit strategy in place, you can help ensure that you are making rational, informed decisions based on your investment goals rather than emotions or market hype. So, take the time to develop a solid exit strategy and stay disciplined in executing it. Don't ignore the risks. While investing in cryptocurrency can be incredibly rewarding, it's important to acknowledge the potential risks and downsides that come along with it. Just like with any other investment, there is no guarantee of returns, and it's important to be aware of the risks involved. Here are a few potential risks you should be aware of. 1. Volatility. Cryptocurrency prices can be extremely volatile. While this volatility can provide the opportunity for big gains, it can also result in big losses. Before investing, be prepared for the possibility that your investment may experience sudden and significant fluctuations in value. 2. Security. Cryptocurrency exchanges and wallets can be vulnerable to hacks and thefts. If you're not careful with your security measures, you could end up losing your entire investment. Make sure to use a reputable exchange or wallet and keep your private keys secure. 3. Regulation. The regulatory environment around cryptocurrencies is still in flux in many parts of the world. Changes to regulations or new restrictions could have a negative impact on the value of your investments. Stay up to date with regulatory developments to avoid any nasty surprises. 4. Adoption. While the adoption of cryptocurrencies has been growing, it's still far from mainstream. If adoption stalls or doesn't pick up as expected, it could have a negative impact on the value of your investments. It's important to acknowledge these risks, but that doesn't mean you shouldn't invest in at all. Rather, it means you should be prepared and informed and have a plan in place to manage your risk. As always, never invest more than you can afford to lose and consult with a financial advisor if you're uncertain about anything. Do stay informed. The world of cryptocurrency is constantly evolving, so it's important to stay informed about the latest developments. Follow trusted news sources and social media accounts to stay up to date on industry news and events. Joining online communities, such as Reddit and Telegram, can also provide valuable insights and allow you to connect with other crypto investors. In addition to keeping up with news and events, it's important to stay informed about the specific cryptocurrencies you invest in. Monitor their performance regularly and pay attention to any major announcements or changes that could affect their value. Staying informed also means being aware of new trends and emerging technologies. Keep an eye out for new cryptocurrencies and blockchain applications that could disrupt the industry, as they may offer new investment opportunities. Remember, staying informed is an ongoing process. Don't just rely on one source for information and be sure to keep an open mind to new ideas and perspectives. By staying informed, you can make more informed investment decisions and navigate the ever-changing world of cryptocurrency with confidence. Don't forget taxes. As with any investment, it's important to understand the tax implications of crypto investing. In the eyes of the IRS, cryptocurrencies are considered property and are therefore subject to capital gains taxes. That means any profits you make from buying and selling crypto will be subject to taxes. It's important to keep track of your crypto transactions and report them accurately on your taxes. Failure to do so can result in penalties and legal issues down the line. There are various tax software programs available that can help you calculate your gains and losses and generate the necessary tax forms. If you're unsure about how to handle your crypto taxes, it's always a good idea to consult with a tax professional who specializes in cryptocurrency. In short, don't overlook the tax implications of crypto investing. Be sure to keep accurate records, report your transactions, and seek professional guidance if needed. It may not be the most exciting aspect of investing, but it's crucial for staying in good standing with the IRS.